Learning outcomes. After studying this module, you shall be able to know about the cost of international capital, know about international CAPM, evaluate the cost of capital in segmented versus integrated markets. Introduction. A firm finances its operations by different sources of finance, like using debt financing or equity financing or mix of both, so that they can minimize their cost of capital. By minimizing the cost of capital, which is used to finance a given project or opportunity, a finance manager able to reduce required rate of return expected by shareholder. Therefore, he is able to make a foreign project more feasible, and as a result of it, he is able to maximize the value of the project. In light of the above, this module helps to find out how to determine cost of equity capital in global financial market. It also helps you to understand how international CAPM is different from domestic and world CAPM. It also explains why domestic cost of capital different from multinational cost of capital. International cost of capital. Generally, a firm's capital structure includes debt, equity and retained earnings. On the one side, the firm cost of retained earning is reflected by the opportunity cost. This opportunity shows expected return which existing shareholders earn if they received their earning and invested these funds themselves. Similarly, cost of new equity also reflects the opportunity cost. However, here the opportunity cost can be seen as what new shareholder can earn if they invested their funds somewhere else. The cost of new equity always exceeds firm's cost of retained earning, as it includes flotation cost, that cost of selling new stock. The cost of debt is simple to calculate because firm has to pay interest on borrowed funds, and this interest represents cost of debt. The main motive of the firm is to maximize shareholders' wealth, which further motivate them to use optimal capital structure, which reduces overall cost of capital. The lower level of cost of capital shows that firm require lower level of required rate of return. Firms will undertake projects if the return is expected to exceed the cost of capital. Required rate of return is equals to cost of capital, then the firm is indifferent. When required rate of return is greater than the cost of capital, then the firm should accept foreign project. And if required rate of return is less than the cost of capital, then the foreign investment is bad investment. Weighted average cost of capital. The required return on equity for any project is depending upon the financial structure and financial risk for firm as whole. Then after tax, cost of debt is added to the cost of equity to obtain weighted cost of capital. The first step is to evaluate any project, or for capital budgeting decision is to find out cost of capital, because the net present value of any project depends upon the cost of capital. Kc is equals to d by d plus e into kd 1 minus t plus e by d plus e into ke, where d is equals to amount of firm's debt, kd represents before tax cost of debt, ke is the cost of financing equity, t represents corporate tax rate, e represents firm's equity, and kc is the weighted cost of capital. The ratios used in the above formula showing percentage of capital represented by debt and equity. On the one side, the benefit to use debt over equity capital lies in the fact that interest payment on debt is tax deductible. Other side, the chance that firm will not able to incur meet its expense increases. Due to the result of the above fact, required rate of return required by potential shareholder increase as financial risk increases, which leads higher chances of bankruptcy. As there is a trade-off between benefit provided by debt, that is tax deductibility of interest payment, and cost of using debt, that it increases financial risk. Therefore, firm has to go for such a capital structure which consists of mix of equity and debt. Domestic versus MNC cost of capital. The cost of capital for foreign investment may differ from domestic firm due to the following characteristics. MNCs is different from domestic firms. First, size of the firm. Generally, MNCs borrow a large amount and therefore receive preferential treatment from creditor, which further reduce cost of capital. Also, as large amount is borrowed by MNC, it helps in reducing flotation cost. However, this advantage available to MNCs due to their large size only and not due to its international business. As MNCs easily achieve growth, they may be more able to increase their size in comparison to the domestic firm and to get preferential treatment for creditor. Second, international capital market access. MNCs are often finding it easy in comparison to domestic firm to often fund from international capital market. Since cost of capital vary in different market, therefore access to international capital market allows MNCs to acquire funds at lower cost than domestic firm. Simultaneously, if cost of capital is lower in host country, then subsidiary make fund available to the parent company as interest rate is relatively lower in the host country. However, the use of the foreign funds does not take away exchange rate risk as revenue generated by subsidiary denominated in same currency. In this scenario, subsidiary is not depending on the parent for financing, although some managerial support provided by the parent company. Third is international diversification. A firm's cost of capital is heavily affected by the chance of failure of the firms. If firm receive cash flows from all the parts of the country, then it is more stable. However, if it is received from single country, then there will be more variability in inflows. Fourth, exchange rate risk exposure. An MNC cash flow is subjected to be more volatile than those of domestic firms in the same industry because it is exposed to higher exchange rate risk. For example, if earnings of subsidiary remitted to the US parent company, then it will not worth same as US currency is stronger than major currency. This creates a problem for MNC as it reduces the firm capability of making interest payment on outstanding debt. As firm exposed to foreign exchange risk possible do not have uncertain cash flow, these will lead to higher cost of capital. Fifth, country risk exposure. An MNC also subjected to the risk that host government may seize their subsidiary assets. The exposure to country risk is caused by many factors like attitude of host government, risk subjected to industry and change in host government tax laws. Therefore, if country risk is high, that is fair competition is not provided to MNC, then chance that firm will go bankrupt will increase and it will further increase the cost of capital for overall MNC. The next topic is cost of equity using different CAPM model. When company take decision whether to invest in foreign project, it must discount the project cash flow at discount rate to expected return required by investor when investing in project directly. The CAPM provides such a discount rate. To know required rate of return of the MNC, which is different from domestic firm, the capital asset pricing, that is CAPM, can be applied. So the required rate of return will be ERI is equals to RF plus beta E into RM minus RF, where RF is the risk-free rate of return, RM is the market return, beta is the beta of stock and RI is the required rate of return. CAPM suggests that there is a positive relation between firm stock return and stock beta. The beta shows responsiveness of stock return to market return. Project beta can also use to determine required rate of return. Project beta shows responsiveness of project cash flow to market conditions. The cash flow generated by each project is subjected to two types of risk. Unsystematic risk is a risk which is unique to particular firm and systematic risk. CAPM suggests that as unsystematic risk can diversify, therefore it can be ignored. The benchmark problem. Market portfolio. The main problem with CAPM is that which portfolio used as market portfolio. Theoretically, the correct value of return on the market portfolio is the weighted return on all assets that are available to investor to invest. If return on market portfolio is measured in dollar, then it must include dollar denominated return on equity of all corporations of the different countries of the world. No one use this version of theory because it requires a lot of data. Also, financial markets are too imperfect to allow as thinking that highly illiquid asset would be bought and sold. Similarly, data on companies bond and government bond is not available. Therefore, people use the CAPM that relate individuals' equity return with market portfolio consist only equities. World market proxies. When CAPM applied in case of particular project, the proxy for market portfolio is represented by a well-diversified portfolio that firms investors are holding. Generally, the Indian companies use NSE stock market index as the market portfolio. However, with increasing globalization of investor portfolio, world market index is more suitable and appropriate. Again, the data on world market index is not available. However, some proxies like the Financial Times Actuaries Index is available. Implications of CAPM for an MNC risk. CAPM theory suggests that cost of capital is lower for MNC in comparison to the domestic firms. The MNC able to increase its foreign sales and therefore able to diversify their risk and reduce beta. Due to the result of this, the required rate of return by investor reduces. In this way, they can reduce their cost of capital. However, if MNC considered unsystematic risk relevant, then required rate of return for MNC project is not lower than for the domestic project. Generally, they perceive higher risk in project carrying in less developed countries as they have volatile economic condition, high degree of political risk, therefore even their cash flow is uncorrelated with parent economy, they won't invest. This shows that unsystematic risk is an important factor that determine foreign firm rate of return. Domestic versus world CAPMs. In case of domestic CAPM, market portfolio is the average asset holdings of all investors in particular country. For example, beta, which is used to calculate systematic risk for an Indian firm which listed in National Stock Exchange, would be calculated relative to value weighted market return on National Stock Exchange. The main assumption of domestic CAPM is that asset of a country held only by the resident of that country. In the mentioned case, there is no international diversification of risk and capital market of a country is completely internationally segmented. However, there is one severe problem with this concept. When CAPM was introduced, international segmentation seemed reasonable because capital flow is limited. Today, in the increasing globalized world, it is appropriate to use international diversified portfolio. This CAPM known as World CAPM. World CAPM. One major problem with World CAPM is that it assumes that investors has same expectation about real return on different asset. However, when real exchange rate fluctuate, investors in different country have different expectation about the real return on different asset. Suppose RE is the real equity return on Indian security and RF is the risk-free rate in India, then the World CAPM states that ERE minus RF is equals to beta into ERM minus RF, where RM is the real return on world market portfolio, RF is the risk-free rate in India, beta is beta on world market portfolio and RE stands for real equity return on Indian security. Because we are interested in finding real return for Indian investor, they are computed on the basis of Indian consumption basket using Indian price level. For example, the real return on equity RE can be computed by real return on equity is equals to 1 plus nominal rate of return on equity minus 1 divided by 1 plus inflation rate. Now, expected return on the Indian security for a German investor will be 1 plus RE euro divided by 1 plus pi in euro is equals to 1 plus RE rupees into 1 plus S divided by 1 plus pi euro, where S represents percentage change in euro rupees exchange rate, but the issue is that rupee based version of CAPM contain real return for Indian investor only is 1 plus RE rupees divided by 1 plus pi rupees. This equals the real rate of German investor when 1 plus S divided by 1 plus pi in euro is equals to 1 upon 1 plus pi in rupees, or 1 plus S is equals to 1 plus pi in euro divided by 1 plus pi in rupees. In other words, the real return for Indian based and German based investor are identical only when purchasing power parity holds. However, in practice, CAPM are mostly applied using nominal returns. Suppose the nominal equity return denoted by RE rupees and let I rupees represent money market interest. So, the world CAPM for Indian based investor is E into RE in rupees minus I in rupees is equals to beta into E into RM in rupees minus I into RE, that is in rupees, where equity return is earned over a short period time such as 1 month. Similarly, interest rate is 1 month T-bill. Therefore, by definition, 1 plus RE into rupees divided by 1 plus pi in rupees is equals to RE in rupees minus IRE, and RF is equals to E into 1 plus I in rupees divided by 1 plus pi in rupees, which is again equals to E into I in rupees minus pi in rupees. International CAPM. It is very difficult to apply world CAPM condition to all the countries. With deviation from parity condition, theories suggest more complex model which considered inflation and exchange rate into expected return computation. One of the model given by Bruno and Solnick in 1980, which suggests following formula for calculation. E into RE in rupees minus I in rupees is equals to beta into E into RM in rupees minus I in rupees plus summation, where K goes from 1 to K into lambda, comma K into E into SK into T plus 1 minus FPK into T, where rupees is numeri and risk is measured for Indian investor. The first term represents standard world risk and the second term represents exchange rate risk. In this equation, SK represents the rate of foreign currency appreciated and FPK is forward premium on currency K. Exchange rate measure rupees per currency K. Investing in foreign currency, K yield and expected return equals to E into SK into T plus 1 minus FPK into T, which is equals to E into SKT plus 1 minus FKT divided by ST, with rupees per K is exchange rate. The lambda measure the exposure of the firm return to exchange rate risk. However, to compute the cost of capital in such framework, we must run a multivariate regression of excess return for security J on world market return and various relevant currency returns. Also, it is not clearly indicated which model is better, world CAPM and international CAPM. Because of the continuing academic controversy, there is limited use of such model in capital budgeting situation. Cost of capital in integrated and segmented markets. Markets are integrated when asset having same level of risk bearing same expected return irrespective of their domicile. The government interference with free capital market in developing market restricts the integration of markets and separates the capital market of country from world capital market. If non-resident are taxed and restricted from holding equity of a country, then country's asset cannot be the part of international capital market and country segmented from international capital markets. There is severe impact of segmentation on cost of capital. For example, if we want to find out the expected return for Colombian stock market, if US stock market is integrated with world capital market, then we use world CAPM and world return as a benchmark portfolio. However, due to low correlation in Colombian capital market and world capital market, it would yield low expected return for US stock market as there is low beta. However, this may be noted that this gives right estimation for capital budgeting for foreigner but clearly obtain poor estimate of expected return for local investor. The research studies indicate that world CAPM gave us a poor estimate of expected return in case of developing market and domestic CAPM work much better. This happens due to the fact that developing markets are segmented, therefore all the securities priced according to their correlation with developing market portfolio and investors are not able to diversify the risk present in developing capital market. As a result of it, developing market will function of its own volatility. The aggregate CAPM to market level will be ERI is equals to RF plus beta into ERE minus RF. For example, in Colombian market, for every J securities, expected return is given by above formula, where RE is the return on Colombian market and beta is the covariance between security J with market portfolio. The above equation can be rewrite as ERI is equals to RF plus covariance of RI and RE into E into RE minus RF divided by variance RE. The expected return of market portfolio divided by its variance called the price of the risk. If the investor holds only equity, then price of the risk is the average risk aversion of the investor in Colombia. If it is denoted by AJ, then equation can be written as ERI is equals to RF plus covariance RI/RE into AJ. Therefore, in the segmented market, the expected return is related to the variance of return rather than the covariance with the world market return. Let us now summarize what we have learnt in this module. A firm finances its operations by using different sources of finance so that they can minimize their cost of capital. By minimizing the cost of capital which is used to finance a given project or opportunity, a finance manager is able to produce required rate of return expected by the shareholder. The main motive of the firm is to maximize shareholders' wealth, which further motivated them to use optimal capital structure, which reduces the overall cost of capital. The lower level of cost of capital shows that firm required lower level of required rate of return. Firms will undertake the projects if the return is expected to exceed the cost of capital. If required rate of return is equals to the cost of capital, then the firm will be indifferent. If required rate of return will be greater than the cost of capital, then the firm should accept the foreign project. And if required rate of return is less than the cost of capital, then foreign investment is a bad investment. The first step is to evaluate any project or for capital budgeting decision is to find out the cost of capital, because net present value of any project depends upon the cost of capital. Kc is equals to d by d plus e into kd 1 minus t plus e by d plus e into ke. The cost of capital for foreign investment may differ from domestic firm due to the following characteristics. MNCs is different from domestic firms because they can borrow large amount and get preferential treatment for investor. They have access to international capital market. They are different as they are exposed to exchange rate fluctuations and subjected to country specific risk. To know the required rate of return of MNC, which is different from domestic firm, the capital asset pricing can be applied. So the required rate of return will be ERI, which is equals to RF plus beta E into RM minus RF. Capm suggests that there is a positive relation between firm stock return and stock beta. The beta shows responsiveness of stock return to market return. The main problem with Capm is that which portfolio used as market portfolio. Theoretically, the correct value of return on the market portfolio is the weighted return on all assets that are available to investor to invest. Then world Capm states that ERE minus RF is equals to beta into ERM minus RF, where RM, that is real return on world market portfolio. Because we are interested in finding real return for Indian investor, they are computed on the basis of Indian consumption basket using India price level. International Capm. It is very difficult to apply world Capm condition to all the countries. With deviation from parity conditions, theories suggest more complex model which considered inflation and exchange rate into expected return computation. One of the model given by Bruno and Solnick in 1980, which suggests the following formula for calculation. E into RE rupees minus I in rupees is equals to beta into E RM in rupees minus I R rupees plus summation k going from 1 to k lambda into ke into sk into t plus 1 minus fpk into t.